If you look at the catalyst, what would that have to be? I mean, would you need to see a resolution from President Xi and President Trump? Do you need to see just tariffs not getting any less bad? Do you need to see Putin and MBS kind of having a handshake and a hug? What is it?
I don't think it necessarily needs a resolution of the China-U.S. So-called trade war. I think what it requires is just a continuation of where we're going. Don't forget, the U.S. is the largest economy in the world, and it's continuing to grow at a very high rate. And that impacts everybody. Even with the trade war, China is going to still need more oil, more commodities of every direction. So I'm not too worried about the situation.
So, Mark, there's no question we will always have commodities with us, and people will pay for them. At the same time, the question is, what's the direction? Whether it's China or the United States, both are growing in their economies, but the direction is they're growing somewhat less fast than they were before. Doesn't that put downward pressure on commodities prices?
It's true. China is growing at a slower pace, but don't forget, 10% in 2010 was a lot less than, let's say, 6% today in China. The amounts are much, much larger. So I'm not saying there's going to be a big jump in commodity prices, but I believe that there's going to continuing to be gradual price rises because, don't forget, the dollar is the key currency.
So, Mark, when we talk about President Xi and President Trump meeting down at the G20 in Buenos Aires, how much of it is actually the bilateral trade relations and what that could mean for the two economies, and how much of it, rather, is potential increased pressure on the Chinese economy? There are a lot of challenges in the Chinese economy internal right now.
Oh, there's no question the debt is very, very high. The debt to GDP in China is actually higher than the U.S. at this stage of the game. So there's no question that they're having real issues. But I think the whole trade issue is now become mixed up with strategic issues. The U.S. now is worried about the growth of Chinese military. They're worried about the data that the Chinese have been getting from the U.S. and many other issues. So unfortunately, it's become a lot more complicated.
Mark, what are you buying right now?
Right now, we're looking at and buying in Korea, in Turkey, believe it or not, because I know Turkey looks pretty bad, but there's some interesting bargains there. In India, that's a very key area for us, and Brazil. Those are the countries that we're looking at now.
And what do you avoid with the 10-foot pole?
Really, we're not avoiding much. I mean, most of the frontier markets we're not into at this stage of the game because there's so many bargains everywhere else. So I would say, you know, African countries, we generally are not doing much there. And in Eastern Europe, there's some interesting things happening, particularly in Poland and Romania. But again, these are relatively small.
But Mark, what about Mexico? I mean, we have an inauguration coming up next Saturday of Mr. Obrador, Luis Obrador. Are you avoiding Mexico until things settle down there? Do you have a read on it? No,
actually, Mexico is another country that I should have mentioned. We believe that Mexico is going to do very well, particularly with the China-U.S. trade war, because a lot of the goods and services that China now is supplying to the U.S. could be moved to Mexico. Not in a massive amount, but it could be significant. So we're pretty bullish on Mexico.
Mark, how much of your view has to be supported by a weaker dollar and a more dovish rate hiking Fed?
Actually, we like a stronger dollar because it makes the emerging market currencies look more competitive. Of course, you know, you've seen Argentine peso go down by 70–80%, Turkish lira, same, so forth. So these currencies are looking very, very cheap now. So actually, I'd be worried if the U.S. dollar gets too strong, because that might not be good for emerging countries.
So what's too strong?
At this stage of the game, the dollar looks a little strong. Other currencies are all down. I mean, if you go down the list, of course, some less than others, but there is really no one currency. Maybe Thailand has not gone down as much as the others, so we've got to watch that. But Thailand looks pretty good as well. So I wouldn't think that there's any currency that is too strong.
So, Mark, when you talk about the strength of the dollar, one of the things we always ask ourselves about is emerging market debt denominated in dollars. How concerned are you about the credit situation?
We're very concerned about companies that have U.S. dollar debt. The good news is that because of the Asian crisis, most of these countries have built up lots of foreign exchange reserves. If you look at the foreign exchange reserves in relation to the GDP, most of these countries are doing very, very well. But you have to be very, very careful of those that have dollar debt, particularly companies. So the first thing we ask is, what does the balance sheet look like, and how much of it is U.S. dollar debt?
So, Mark, Morgan Stanley had a pretty monster call out today, basically saying that U.S. growth next year is going to sharply slow, in particular into the third quarter of 2019. Growth here is only going to be about 1%. So they say what you want to do is you want to get out of U.S. equities, go outside. You want to get into cash, and you want to go into emerging markets. If this pans out, are you going to have more competition to spend the dollars that you want to spend in emerging markets?
Absolutely, there's no question about that, and which is why we're very eager to get invested now, because emerging markets look so cheap. I'm afraid it may not be lasting. And if you look at the emerging markets index, it's still going down. I mean, we haven't seen any big recovery, but the U.S. market, of course, has faltered. We've seen, what, a 10% decline from the top. So I think, yes, their money is going to be moving out of the U.S. dollar and the U.S. market into emerging markets eventually. It's not going to happen overnight, but I think going into next year, you're going to see more money going into these other markets.